The S&P 500 is hands down the most famous index in the world. But by focusing only on the S&P 500, are we missing out on bigger opportunities in the rest of the world? And most importantly, which one will help you build wealth faster? The S&P 500 or a global index fund? That's exactly what we're going to figure out in this video. Let's start by looking at the high-level stats and then dive a little deeper. I'm sure many of you are already familiar with the S&P 500. As the name suggests, it includes around 500 companies. These are the big household names and tech giants like Apple, Microsoft, Google, and Amazon. Together, these companies represent trillions of dollars in market cap, far larger than most stock markets worldwide. Now, if we look at the global index funds, such as the FTSE All-World Index, we still get all those same companies and a lot more on top of that. So if we're just comparing the number of companies, this is where a global index fund really stands out. Right now, the FTSE Global Index includes over 3,600 companies. As you can see on the screen, the big US names are still at the top. But as you scroll through the list, you'll start to see companies based outside the US. But here is the real question. Does having more than 3,600 stocks in a fund actually make a difference? Do you really need that many companies, or are you just overcomplicating things and spreading yourself too thin? Because at the end of the day, it all comes down to one thing: returns. The historical return of the S&P 500 is around 10% per year on average, while the global stock market has returned approximately 8%. So let's say your goal is to reach £500,000. If you started investing £300 per month in the S&P 500 today, it would take you about 27 years to get there. On the other hand, if you invested the same amount in a global index fund, with an average 8% return per year, it would take you around 31 years to hit that same target. Therefore, from a returns perspective, all things being equal, the S&P 500 clearly gets you rich faster. So there you have it then. Case closed, right? Well, maybe not. Is it really that simple, or are we overlooking a few other important factors? Here's the thing. This calculation relies on historical returns, which are no guarantee of future performance. Plus, returns aren't the only factor we should consider when planning for our financial goals. What about other aspects? Can we really be certain that the S&P 500 will continue to be the dominant index in the years to come? What we're really interested in now is the future. And here is where the numbers start to matter. The S&P 500 is certainly well diversified. It includes companies from a wide range of industries that sell products and services all over the world, from big tech to pharmaceuticals to industrial giants and oil companies. Over time, the index has changed, with older companies phasing out and new ones taking their place. However, in recent years, we've experienced a massive bull market, especially for big tech and mega cap companies. These have performed incredibly well, leading to a significant concentration of value at the top of the index. Take a look at the current weightings of the S&P 500. The biggest holdings include Apple, Microsoft, Amazon, Nvidia, and others. In fact, the top 10 stocks alone now make up almost 35% of the entire fund. Now let's compare that to a global index fund. In a global fund, the top 10 holdings make up only about 20% of the total. This means that by choosing the global route, you're spreading your investments across a much wider range of companies and industries, offering significantly more diversification. Also, in terms of sectors, this is really interesting too. As you can see, the S&P 500 is heavily tech-dominated, meaning a large chunk of your wealth is tied up in already massive companies. But if you look at the global index fund, the sector breakdown isn't quite the same, and you get more exposure to industries like industrials and financials. So with the S&P 500, you might be missing out on some growth in some of these other sectors. But then again, who knows what's next? One thing I know for sure is that it really helps the channel if you hit that subscribe button. Thank you so much. The truth is, there is no way to know for certain whether the S&P 500 or a global index fund will outperform over the next 10, 20, or even 30 years. For all we know, the next 20 years could be a great time for international stocks outside the US. Let's be honest, the US market is so popular and well known that it's hard not to think everything must already be priced in. Meanwhile, international stocks have often been left in the shadows, only occasionally getting attention when the spotlight shifts. However, the truth is that stocks outside the US have at times actually outperformed the S&P 500 during certain periods. As you can see from this chart, every time this blue area is above the middle line, it means that the US has beaten international stocks. And every time the blue lines are below, it means international stocks have done better. What we're seeing here is a cycle that has played out over many decades. Are we possibly due for another cycle where US stocks outperform for a while? No one can say for certain, but it's a good reminder that the world is much bigger now. And there are plenty of companies out there that could become giants. Companies that no one is even talking about right now. So for a new investor starting today, will they experience another great run with US stocks, with the S&P 500 leading the way? Or are those blue bars about to flip as stock markets around the world start to gain more attention? One important point to consider is that global funds include companies from rapidly growing economies like India, China, and Brazil. These markets can offer substantial long-term returns, even if their performance can be more volatile in the short term. Now let's talk about the good old US dollar and currency exchange rates. As of today, the dollar makes up almost 60% of all foreign exchange reserves and more than 80% of global foreign reserve trading. But why does this matter? Well, nearly everything that drives the global economy is traded in dollars. To buy these goods and services, we need to exchange our own currency for dollars, which puts many of us outside the US in a tricky position. As the demand for dollars fluctuates daily, we are essentially at the mercy of the exchange rate. Here in the UK, the value of the pound can be weak or strong at any given time. When the pound is weak, everything we buy in dollars becomes more expensive, including our investments. It's nice if you need to sell some stocks, as you might get a bit more for them. But it's not great for building wealth, because it costs more to buy things in dollars. Over the long term, you'd hope things balance out. If you invest regularly, sometimes you'll get a good exchange rate, and other times it will be a bit more expensive. But what if when you're ready to retire and start selling your stocks, the exchange rate isn't in your favor? Unfortunately, there might not be much you can do about it, which is another reason why you might want to consider a global index fund. With a global fund, you get exposure to a mix of currencies, so you're not dependent on the dollar. Now, I won't go into it here, but some people prefer using a hedged approach to protect against currency fluctuations. However, there is a risk with that too, and those funds tend to be more expensive, which just kind of brings you back to square one. But if you'd rather not spend too much time worrying about global currency exchange rates, then just leave it to the market. Focus on investing, because as we know, things can get complicated pretty quickly. Alright, let's dive into a popular topic now, valuations. In other words, how cheap or expensive the S&P 500 is compared to a global index fund. There are always people out there who claim that the S&P 500 is massively overvalued. And for that reason, they argue that a global index fund is the smarter choice. To illustrate, let's look at the long-term PE ratio for the S&P 500, which in theory gives us a good sense of whether the stock market is cheap or expensive compared to its history. Right now, the PE ratio for the S&P 500 is around 24.5, while the long-term average is closer to 16. At first glance, you might think, wow, that looks pretty expensive. Maybe I should hold off on investing or I could lose all my money. But here is the thing. While valuations do matter and the PE ratio can be a helpful guide in the long term, we are not comparing the same kinds of companies. Over time, the companies in the index have changed completely, and the world looks nothing like it did just a few decades ago. Think about it. Imagine one version of the S&P 500 was made up of slow-growing, established companies. Then compare that to another S&P 500 where all the companies are fast-growing tech giants. Just based on that alone, you would have to agree that the second version should have a higher PE ratio because of its growth potential and future prospects. Well, this is essentially the situation we have today, where the S&P 500 of today looks almost unrecognizable from just a few decades ago. Technology has really changed everything. I'm sure you'd agree that today's tech giants are much higher quality companies that are delivering more profits than ever before. Another important point worth mentioning is that investing in an S&P 500 ETF is generally much cheaper. For example, a fund like the Vanguard S&P 500 ETF costs only 0.07% per year. In contrast, the Global Index Fund can cost up to 0.23% per year, which is more than 3 times more expensive. Based on this fact alone, you could argue that the S&P 500 is the better option, as over time, those extra costs can really add up and eat into your returns. So what do we do as investors? Which one is faster for building wealth? And does all of this really tell us which index fund is the best? Well, here is my take. If you're aiming for faster wealth accumulation and you believe the US market will continue to dominate, the S&P 500 is probably the better choice due to its higher historical returns. However, if you're looking for a more stable, globally diversified approach, a global index fund might be the smarter choice. While it may grow a bit slower, it provides protection against downturns in any one region and positions you to benefit from growth in other parts of the world. In my opinion, both strategies should do really well in the long run. And honestly, I wouldn't lose too much sleep if you just invested in the S&P 500 and didn't look elsewhere. As many of you probably know, most active fund managers struggle to beat the S&P 500 year after year, and over time they generally perform worse. So based on that alone, it's a pretty clear winner in my book. Also remember that a global index fund like the FTSE All World Index essentially includes the S&P 500 within it. It holds all those US companies because it's based on market cap. So you're not missing out on the growth from those big tech giants. From my perspective, the market moves in cycles as the world changes, and we never really know exactly where we are in that cycle. The important thing is to invest regularly over the long term and keep buying both in good times and bad times. So for me, I am mostly global, and I plan to stick with that. But of course, you might decide otherwise. For instance, you might decide to go the dividend investing route and try to generate monthly passive income. If that's the case, check out this video to find out what it really takes to make £1,000 per month in dividend income. See you there.